Thank you, Jean-Claude. I hear you loud and clear on timing. So I will make use of your reference to the creation of the G20. After all, the principal institutional response to the global financial crisis was the creation of the G20 at the leaders level, a change that I think was underestimated in its potential importance because the G20 pre-existed at the finance minister and central bank governor level. The initial G20, I'll use this as an introduction, the initial G20 Leaders Summit in November 2008 set 4 principal goals for their action. 1, restore global growth. 2, repair and reform the financial system. 3, avoid new trade protectionism and promote new trade liberalization. And 4, reform the IFIs. And let me just take a quick tour of where things stand today in regards to those goals. First, with regards to growth, the IMF's latest projections released a month ago contemplated 3.1% global growth this year, 3.4% next year, with the advanced economies growing about 1.6 this year and 1.8 next year, in other words, slightly better, with the US improving and Europe slowing from the 2016 performance. Emerging and developing economies growing at 4.2% this year, 4.6% next year. But when we take a step back and ask, so where are we? What that means is for the advanced economies, their projected growth this year, next year, and beyond is still below their 30-year average growth rates. In other words, not only are the advanced economies have not compensated in their growth for the recession, they're not even back to their long-term average, creating the obvious question of why and also how much excess capacity is actually left. For the emerging and developing economies, that growth rate means that they are now at their now are and will be at their 30-year average growth rate. In other words, the earlier growth leadership that had been assumed in the post-crisis period, in which emerging and developing economies grew much faster than their long-term average, is receding. And the expectation is that that is going to be a challenge going forward, even for these economies to maintain that rate, as it is expected that the Chinese economy's growth is going to slow. So what is the principal problem? The title of the IMF's World Economic Outlook published last month was Subdued Demand. But when you look at where demand is subdued, it's not in consumer spending. Consumers are spending normally relative to their income. It's a shortfall of business investment. And this shortfall is seen, in essence, everywhere, although the Chinese experience is special, and I'll explain in a minute. But in general, business investment has been slowing, and with it, no surprise, growth in productivity has been slowing, as you would expect. If you're not investing at the same rate as previously, how would you expect productivity growth to do anything other than slow? Why I point out China is because Chinese investment remains dramatically higher as a percent of GDP than almost any other major economy, perhaps every other economy, and yet it's starting to slow, and most notably, despite this very high rate of investment, productivity growth in China has slowed sharply, according to IMF figures, and is now growing at about the same pace as emerging markets as a whole. In other words, so the imperative for economic reform in China is shown very clearly that investment remains very high, but productivity growth as a result is not high. So the challenge is to figure out what is it that is inhibiting business investment and how can it be restarted. In the near term, you can see the unexpected response of financial markets to the unexpected election of Donald Trump as President of the United States and the expectation that at the minimum, on the margin, U.S. fiscal policy is going to turn more expansionary, and hence, if anything, the risks are for somewhat faster growth in the U.S. economy than was expected, at least in the near term, and that has cemented expectations that the actions of the Federal Reserve to raise interest rates is imminent, or the beginning of that process is imminent, widely expected to begin in December, at their December meeting. And given the outlook for growth, the expectation, market expectation increasingly is that monetary policy among the major central banks will be diverging over the coming months, as we've had new commitments for either sustained or expanded monetary accommodation in both the European Central Bank and Japan, and uncertain prospects about the Bank of England. Just to run through the rest of the points. Financial sector reform, repair and reform. The principle, as Jean-Claude pointed out, the G20 mandated the creation of the expansion of the FSF into the FSB by including all G20 members. I would say today, if the goal was a thorough and even financial sector reform, the twin goals were to enhance systemic stability and to level the playing field. And I would say that in both of those, the verdict has to be an incomplete so far. And if anything, I think financial markets probably remain more balkanized than they were before the crisis, not the other way around. And a new uncertainty has been injected by the election of President Trump, as in his campaign he has mentioned an intention to rewrite Dodd-Frank. So instead of having the basic framework established and we're filling in the details, now there is the prospect for renewed change. In trade, certainly we've moved from in November 2008, then President Bush said his principal goal for the rest of his administration was to achieve approval of the Doha development round of the WTO. It's dead, and it looks like after the American elections, TPP is dead, and it looks like TTIP is dead. We're in a, let's call it charitably uncertain moment. And with IFIs, maybe I should come back to that because my watch tells me I am at 8 minutes. We can deal with that later. Thank you, Jean-Claude.
Thank you very, very much indeed, John, and thank you for your very remarkable synthesis that you made. I was myself so aware of the fact that we were starting late that I compressed to the maximum amount my own introduction, but also only to mention, John, that you are a senior fellow in Johns Hopkins Paul Nitze School of Advanced International Studies, and you were, of course, the legendary former first deputy managing director of the IMF that a lot of us have known and admire when you were in this position. And you were also a former vice chairman of JP Morgan Investment Bank. So, as I said, wealth of experience and of a remarkable gathering of, I would say, crisis, by the way.